Hey guys, welcome back to the Investor Army podcast. Today we have a great guest, and let me ask you something. A lot of y'all watch those HGTV flipping shows, right? And you want to learn how to be a rehabber. Well, in order to do that, you got to have money. And today's guest can do that for you, especially if you're in the Dallas-Fort Worth market. If you're a new wholesaler trying to get transition into flipping houses, he can help you do that. He's a full-time real estate investor as well. He has a rental portfolio. He flips houses himself. But guys, we're going to be talking about hard money lending today, and our guest is Brent Conrad. How you doing, Brent?
Doing well. Thanks for having me on, Connor.
Okay, so Brent runs Conrad Lending or CRlend here in DFW. You can also find him online at DFW Cash for Houses, right? Because he is an investor. So if you want to partner with him or bring him deals, that's a good way to find him. But we're going to be talking about hard money and kind of the process, because a lot of you as investors, especially wholesalers, think if you just find a good deal that you're all in at 70 cents on the dollar, you're not going to have to bring any money to the table. That's just not how it is. So we're going to quickly let Brent introduce himself and talk about how he became a hard money lender, how he made that transition, and then we're going to go into the whole process of the hard money loan process. So Brent, how did you start out investing, and then how did you kind of transition into being a hard money lender?
Well, like I said, started out, flipping, or I am a full-time investor. So what happened is I didn't have any money when I first started as well. I just had a couple, maybe 10, 15 grand. So what I started doing was finding these deals and then wholesaling them. And that built up cash reserves, of course. And then at some point, I had enough money to go and actually buy a house and flip it and renovate it, or renovate and flip it. So I started buying houses, flipping them, and then that turned into more cash, of course, and then transitioned into the hard money lending business. So what happened is I was flipping 4 to 5 houses at a time. I had a pipeline going, and I got a little burnt out, to be honest with you. It's still a great thing. I still do it from time to time, but I'm more focusing on the finance part. So what happened was I had a house. I just didn't want to flip it at the current moment because I had some other projects going on and other avenues, other divisions of my company that I was building. So I decided to list it as is. An investor came and made me an offer with an agent that was on there when I listed on MLS. And he said, what can you take for it? Blah, blah, blah. He did the whole back and forth game. And we eventually settled on a price. And I said, well, are you paying cash or are you getting a loan? And he said, I'm getting a loan. And I said, well, is it a hard money loan? He goes, yeah. I said, well, I already own the house and I have extra cash just sitting around. So why not just replace your current investor or your current lender? And I go, what are you charging? And he said, well, they're charging me 14 and 4 and a bunch of other fees. And I said, okay, well, I'll do it for 12 and 2. So he said, well, no brainer. Of course, we just signed loan documents and he bought the house. I was his lender. He renovated it, flipped it, sold it, made his profit, and I was his bank. So ever since then, a light bulb kind of went off and I said, okay, well, I should just be a lender and start working with local investors and providing them the access to capital they need in order to flip these houses, but at a much lower rate. So now we're hovering around 12 to 14% and 10 to 14%, and then also 2 to 4 points, depending on the situation, the house. But the majority, nobody really goes for the 4 points and 10% option is one of what we have. It's really hovering around 12 and a quarter, 12% to 2.5 points.
Yeah.
So
guys, the lender is the best seat in the house, right? And so what he told you is he transitioned from flipping, and a lot of people like Brent considered flipping originally. He was using flipping for 2 different terms: wholesaling and rehabbing houses. So some people consider just wholesaling flipping houses as well. So he started out. What year did you start out?
2009. I've been in business since '05, but 2009 is when I really jumped in full time and was doing the wholesaling and quote unquote flipping. Yes.
So just to give y'all time frames, because a lot of y'all out there listening are starting the business and you're wholesalers. So he was able to transition from, wholesaling houses to rehabbing houses traditionally, like you see buy, fix, and flips, and then moved into being a lender. And you can kind of see that timeline. And he talked about...
And as far as that timeline goes, it was 2009. And then I've been lending now for almost 5 years. So that's roughly 2012 is when I basically turned into hard money lender. So there's a little bit of a time, 09 to 12 till now. So anyway, sorry, go ahead.
No, you're good. So guys, a lot of y'all think that if you just find a house where, let's use $100,000 for a good, easy number, right? And your hard money lender in your area says that they're going to lend 70 cents on the dollar or $70,000 on that 100,000. and you find a house for 50,000 and it only needs 20,000 repair, that you can just go to that hard money lender. He's going to fund you the whole amount. That's not how it works. And I want Brent to kind of talk about the process of getting into a loan as far as what they need to provide. You talked about 2 and 12, 4 and 14. A lot of people probably don't understand that, the difference in the points up front as far as the points on the back end. Let's kind of go through the whole structure of your fees and kind of what people are looking at facing as far as if they get into a loan working with you, or if they're in a different state, kind of how to approach their hard money lender.
Yeah, so everybody's different, like you said. Different lenders will charge different amounts and different terms. So, just kind of starting from the very beginning, we do not charge any, on the points and the processing fees and everything of that nature. Those are all due up front with us at closing. There are no upfront fees if you don't close. So some lenders will charge you a application fee or a review fee, but if you don't close the loan, you owe us $0. But some lenders will, as Connor was saying, or you were saying, you'll have to pay it on the back end, the point and the interest rate. So the interest rate is basically your monthly interest that is due on the note, and that's just like any other car note, mortgage note, anything you're financing, furniture. It's all the same. It's an interest rate. So you're paying that monthly payment to the bank, just as if it was Chase or Wells Fargo. The points or origination fees are basically upfront points that a lender will charge. And if it's 2 points, it's very simple. It's just 1% for each point. So on 2 points on a $100,000 loan, you're looking at $2,000 for the 2-point origination. But going back to kind of the process in the beginning. So at CRlending, we don't have a requirement as far as there's no appraisal needed, there's no survey needed, there's no credit check, there's no prepayment penalty, there's no pre-inspection required on the home, meaning we're not going to have you hire a professional inspector. Now we're going to have somebody, either you guys do a video walkthrough or somebody from our company come by and actually look at the home to make sure it's not burnt down or something crazy, right? But other than that, we're pretty easy. We like to streamline everything, make it super simple, super easy. And that's quite honestly why we don't even really advertise that much, because we get so much referral business because we're so easy to work with. And we just get a ton of referrals that way. And people just say, hey, you got to call Brent and CRlending because they're going to knock it out of the ballpark, and we do what we say we're going to do. I can't tell you how many times a hard money lender will say they'll fund something, and then we get a call 2 days prior to funding and they backed out for whatever reason. The appraisal didn't come in right, or I don't even know. There's all sorts of stories, or they just changed their mind and they just flaked because it was more of a smaller private lender or smaller hard money lending company. But so basically, whether it's me or another company out there in another state, you're going to have to go and see what their requirements are. Again, mine's a little bit unique in the fact that no survey, no appraisal, no credit check, yada, yada, yada. So it's really just for us. You go on our website, you fill out the application and send us an executed contract. So we'll review it, we'll look at it. And again, simple numbers like Connor was saying, if it's worth $100,000 and you're buying it for 50, we lend up to 70% of the ARV or after repair value. So we can give you $70,000 on that purchase or that acquisition. And then what we'll do is, if you're buying it for 50 and we're lending it at 70, we're going to send in $70,000 to the title company, right? Well, there's obviously 50 grand going to acquisition of the home, or to the seller, if you will, because the title company's got to send that off. And then there's 20 grand left over. Well, you don't just get 20 grand in your pocket. That would be a great scenario for everybody, but that's just not the way the world works in finance. So that 20,000 will be placed in escrow with an attorney at a law firm that holds it. It's a neutral third party, and that will be used for your repair money. So you can go through and say, hey, Brent, we finished the foundation, the roof. It was $10,000. We go in and we inspect the home. We go, okay, yep, roof and foundation are complete. And then we release your $10,000 to you. Now, going back to what you were saying, Connor, was you're not going to just get 100% financing up front initially. We actually do offer 100% financing. You can get zero out of pocket as far as rehab dollars go on these loans. And what I mean by that is, let's go back to that example. On a $100,000 ARV, and we lend up to 70, so we're giving you 70 grand for the home, but we might say something like, hey, we'll give you $70,000, Mr. Rehabber, but we want you to throw in around 10%. So in this case, 7 grand. You throw in 7 grand, we've got 20 grand. So now your escrow balance is 27,000, 7 from you, 20 from us to use on repairs. Obviously, in this exact scenario, nobody's probably going to buy a house for 50 and throw in $27,000 in renovations because the margins just aren't there. It doesn't make sense. But we're just using these numbers for simplistic purposes. So in that case, we would release all 27,000 back to you, effectively giving you 100% financing because you got your 7,000 that was put down temporarily. You get it back through the repair process. So there, you're 100% financed. Now, the only thing that you're not really 100% on is your points, your process fee, your insurance costs for the home, title company closing costs. But that's nominal. It's not like a true 10% or $20,000 that you're throwing down and you're having to hold out of your pocket.
Yeah.
So I mean, sorry. That's pretty much the gist of it.
No, that's really good. I mean, he basically broke it down for you guys. So the reason why they want you to leave a temporary down payment in there is they want you to have some risk in the game, some skin in the game, so that you kind of feel that pain, right? And also, we'll talk a little bit about here in a second about the payment structure once you're in the loan on the backside. So on Brent's loans, like the ones he does for me, it's 2 and 12, right? And so the points on the upfront on 100,000 would be 2,000 up front. Then we have a few origination fees and the closing costs and then the temporary down payment. So typically I'm in there for $15,000. And then we start the rehab process and we have the draw process. But how do you handle, the payment of the loan? Some people do it and we'll wrap it all to the back end. Some people do it monthly, and I know how you do it. But just kind of give the different takes on how different hard money lenders may do this, because a lot of investors, their main goal, just like when you said you started out, didn't have a lot of money, and so they're trying to figure out how to come as little out of pocket as possible, which is probably why a lot of people aren't doing the 4 points and 10 points, because
it gets too expensive. So there are hard money lenders, very few and far between, that will allow you to defer the payments until the note pays off or until it sells. But the problem with that is, just from a lending standpoint, and think about if you lent your friend money or anybody money on any kind of deal, and all of a sudden, you go, okay, I need my money back, the note's over, or the note is due, and the house is supposedly done, or, you finance furniture or a car for them, whatever, and then they go, well, we don't have any money to pay you off, or we're in trouble, we don't have any money. Well, you just went 4, 5, 6 months, and you don't have anything to show for it, and you didn't know anything was off. So our monthly payments are a gauge that everything's going okay. So if you make your monthly payments, we know everything's okay. If you miss one, there's an a whoopsies, something going on. So again, it's going back to the big boys, Chase, Wells Fargo, Bank of America. They're requiring monthly payments on car notes, house notes. That's how they gauge if the loan is performing well. So there are lenders that will allow you to do it. I've not really seen any lately because of the whole mortgage crisis that came down on everybody's head. It was, that was another thing that happened. So the points too. So there are lenders that will allow you to put some points on the back end of the loan. But I typically find that they're charging you more. So they might say, okay, yeah, we'll do 1 point up front at closing, and then we'll do 2 points on the back. Well, that saves you money in the short term out of pocket, but you're paying more in the long run because you just paid another point on the end, 3 instead of 2 to us, for example.
And so you're
or it could be 2 and 2.
Which is what I see as well. That if anytime it's deferred on the front or to the back end off the front side, it's always more. So if you have the ability to leave that cash in, it's just better to go for it on the front side.
And look, if you guys want to pay me more money, I'll definitely take it. But I mean, that's, I joke when I say that. I mean, we might be able to work something out like that, but I like to just give people honest advice. And look, we're not just doing loans to give loans. So the good thing about going through a hard money lender, and not just me, some lenders will do a loan just to do a loan. But my point is, with us, you're getting a second professional pair of eyes, or maybe a third professional pair of eyes if you're going through Connor. And then, for example, through us, I mean, I don't want to lend money to anybody on a house that it's going to set them up for failure. That does me no good, because they're just going to default, or it's going to put them in a hole. and it does them no good because they're going to lose money. And of course, I won't get any repeat business from that. So if somebody's saying, hey, I think it's worth 150 grand, I think I can sell it for that. And I run the comps, and we run our own internal BPO, which is just an appraisal, basically. Fancy word for appraisal is you might just have to take a step back and think about, okay, if the hard money lender's saying it's only worth 100 and Connor's only saying it's worth 100, and somebody else saying maybe we're paying too much, or maybe we can't get what we think, and maybe we should just skip on this deal.
Yep.
So that's just food for thought.
No, that's a great point, because a lot of y'all have lenders in your area. You want to make sure that they know the business, they've done it. You don't want them, because there are predatory lenders. They don't care if you succeed or not, and they just want to get that loan out and get their points. But he does a great job, guys. He knows the market here in DFW really well. You send him a property pretty much in any city. Like, how far are you branching out here in DFW? I know you don't want to go up toward like Grayson County, or what about like on out west? Are you going out to Azle or south towards Waxahachie, or how far do you range?
We'll look at anything really. I mean, we really want to stay like within DFW. Like, I would say Waco's too far. Obviously, Austin, San Antonio, Houston, those are too far out for us right now. We like to stay local. And I mean, Denison can be looked at. Sherman can be looked at. It's just going to be harder in those secondary markets because two reasons. I mean, number one, they're secondary markets. Not everybody wants to live in Denison, Texas. There's more people that want to live in Garland, Texas than Denison or Plano or Frisco, obviously. So, and then second reason is comps. There's not as much activity, so it's harder sometimes to grab those comparable solds and go, yeah, it's worth 100,000. So those are the two main factors. But we'll look at anything, and we'll try to make deals work. And even if we're off, for an example, on ARV, let's say go back to that example where somebody thinks it's worth 150 and we're saying 100. We're not usually that far off, especially on the low end properties. That's just an easy number example. 50 grand would be more something like $400,000, $500,000 range. We could easily be off 50 grand as far as after repair value between the investor and us. But even in those examples or those events, we will lend a little bit more money if you have a little bit more temporary money to put down. Meaning, let's say we only require $15,000 on a $150,000 loan, typically somewhere in that range temporarily. Again, you get that 15 grand back if you perform, of course, and everything goes well. But maybe we say, okay, we'll put down 25. I'll lend you the 150 because you're putting down more money, and at the end of the loan, we'll have 150,000 in, and maybe we're a little over 70%.
Yeah.
But the good thing about being with a smaller lender like us is we can make those exceptions. Not everything is black and white, right? So the way I look at it is, okay, well, maybe we're 150 in, and the home's completely done with granite, paint, new bathrooms, and we're a little bit over 70. But I mean, if it's worth, 210 or 220, let's just say, for example, then we're still, fairly, or even 190. Let's just go a little on the opposite direction. Sorry, 190. Still have a $40,000 margin of error there. Yeah. So the reason being is we'll do that because we have that extra $10,000 put down from the borrower to make us feel a little bit more comfortable that we can ride it out with the rehab with them.
I mean, it's less risk for y'all. I mean, it's the same thing, guys, as far as like if you had a property that you're going to rent and you were a little hesitant about that tenant, and they're like, well, what if I leave 2 months security deposit up front, right, and leave a little bit extra money in there, so it's going to kind of alleviate that pain for you. So, like, let's touch back on, because a lot of people, I don't know how often you're getting in disputes over, the lending amount, how much you're going to lend, because obviously you take 10 different people and give them the same property, you're going to get 10 different numbers, plus people are going to come in and somebody can do it for 15, and you
right.
know from rehabbing it, you're like, that's not getting done for 15, straight up, and you know it.
Right.
And they may not know, and so if you, like you're pointing out in Sherman, there's less comps. So like what happens when you get into a situation where you have like one outlier comp that's kind of higher, and then like one, like comps are spread out and it's just hard to comp it. Guys, in my opinion, you as the investor you're going to lose every time because they're the ones making the decision. But how do you kind of approach that situation? And when you're lending, as far as the comp process, like how do you look at your comps? How many good comps do you need? And
yeah, good question. I mean, it's usually a minimum of 3 is a really good gauge. I mean, so first thing we do is we stay within the subdivision, number one. Let's just say it's Park Place, and that's the subdivision name. So we look in the subdivision only Park Place, and we go back a year. We try to use 6 months of comps, but with the market being as hot as it is, we try and go back a year now just to gauge the entire 365 days, last activity anyways. So we look in the subdivision only. If there's enough comps within that subdivision, there's no reason to go out anywhere else. At that point, you're just fishing to try and make a deal work. And it's funny you bring this up, because I just had one yesterday where a lady had said it was worth 370 grand, and the appraisal, then after they hired an appraiser, they come out and do a formal appraisal, just like a big boy bank, and they came in at the same exact valuation or close to. When I say exact, when you're talking 10 grand within margin, your guys are pretty much on, the same ARV or the same comparable valuation. So we came in at like 330, and the appraiser came in at 335. And she's saying it's worth 370, but she was like, but wait, it's because I have all these other comps. And both the appraiser and I are like, we didn't talk, but I know what he's thinking because I've been doing this for a long time. Why are we going to go outside of the subdivision just to grab homes that are hot selling for higher price per foot when we had like 7 comps within the subdivision? Why would you go? You're just I can make any house comp higher if I go find the solds outside of the neighborhood, if it makes sense. So we use the subdivision first. If we don't have enough comps within the subdivision, we'll map an area, meaning we try to stay within a quadrant of major roads. So, you've got 635 and Webb Chapel, or 635, 75, and these are big examples, but major roads, when I say major, not even highways, but your Preston Road, for example, or Royal Lane, and you stay within those quadrants, and then we'll use that quadrant, that square, and pull all the comps, because within that quadrant, there could be several hundred homes that sold, and they're between 1960 and 1970, and our subject property is 1965. They're just not all Park Place subdivision, so we can still use those comps.
Yeah, because I see that commonly, especially with wholesalers out there. People they try to make numbers work however they can, and I look on, I start out on the street first. Hopefully I can find as close. I look as close as possible and then kind of branch out, but I never go outside the subdivision because, especially if I'm taking title to one, if I'm wholesaling it, there's not a lot of comps. Obviously I'm going to have to go out there, but you want to, especially if you're buying these houses to flip, you want to make money. Nobody likes working for 4 months and not making any money, but like where I live in Old Shepherd Place here, like you can literally go a quarter mile over to Willow Bend Country and the houses go from, 400 to 700,000 all the way up to like 1.5 to 4 million. So if you're just looking at things from the MLS or the comps on a graph, you're not going to be able to tell unless you kind of know that neighborhood.
Right.
So once they get a loan from you, kind of explain the draw process for people, because you pointed out earlier, you don't just get your 20 grand right up front. That'd be stupid. Right. That'd be stupid for the lender. So they're not going to give you all your rehab money up front. You're going to have to fund the first part of the draw, right? Or the first part of the rehab, and then you're going to get a draw. Can you kind of explain to them what that is? Because a lot of people don't understand that process.
Yeah, and I will, and I'm going to jump to that next. And I apologize. You asked a question earlier, and I'll jump back to it real quickly. The payments. You had asked, and I kind of rambled off to something else. We require monthly auto draft on all of our payments, because you have to imagine, and some people will go, well, can't you just take a check for me, or can't you just make this exception for me? When you've got over 100 plus loans, you can imagine, and some of you with rental properties, or any kind of volume in anything in the world, babysitting 2 kids is a lot easier than babysitting 20 kids. So you have to have certain rules and standards and policies and processes in place to make it streamlined. That is not only to make our life easier, but to make service better for you guys. And that's why on our website, we have everybody fill out the form. We just kind of got to that point, to be honest, because we've gotten bigger. But a lot of our pre-existing customers are like, do I really have to go online and fill this out? And we're like, yeah, because it avoids 30 or 40 different emails back and forth and cuts it down to 5, because we already have all the information instead of going back and forth. Anyways, as far as the draws, moving on to that. So what we do is we typically do it 2 different ways. There's 2 structures, and there's really no wrong or right. It just kind of gives people an option. Let's just say it's $10,000 escrow holdback or temporary down, including the investor's money. Or let's just back up. Let's say it's $10,000 from our loan left over and $5,000 from the rehabber. So we have 15 grand. So we'll say, hey, look, we'll give you $7,500 halfway through the rehab and $7,500 upon completion of the rehab. When you've got the sign in the yard, cookies are burning, open house signs, whatever, it's done. And then at that point, you're fully 100% funded. You don't have any money in the home as far as, again, down payment. You're going to have little minor fees here and there. That's one way, half and half. The second way we do it is we will say, hey, look, we'll do an 80-20 split or draw. So every time you request a draw, you ask for $10,000, we're going to give you $8,000, keeping 20% in it. The whole reason for that is, like you were saying, Connor, it just keeps us skin in the game as the lender and the rehabber skin in the game as the rehab or having money in it. So that way nobody can just walk away and go, you know what, we have all our money out of this, we're done, we quit. Life comes up, situations happen, emergencies happen, unfortunately, and we want to have everybody have their skin in the game until that home is complete. And once it's done, then it's done, and you can sell it and make your money. And we don't hold your money again until you sell it. We just hold it or we release draws until you're completed with the rehab. So if it takes you 2 weeks to rehab, you get all your money back in 2 weeks.
And what I like about Brent and Conrad Lending is that they're quick to release that money, because I know, so guys around the country, you're going to have different lenders, and there's going to be a wide range. They're all going to have their own way that they do things, and some of them aren't so investor friendly, right? And so they're going to want to do like inspections, right? They want to prove, because some of them, believe it or not, investors, guys, some of y'all take pictures to make things look like more is done or whatever, and y'all play those games, and some charge inspection reports and come out there each time. Plus, it just delays that project. And when we got carrying costs, water, electric, taxes, insurance, and those loan fees kicking in, and if they can't get out there for 2 or 3 days and they're not going to release the next draw, and your contractors are wanting to get paid, you kind of stuck in that deal, right? So you need to make sure that you have a lender that's going to be quick to release those draws, and Brent does a good job at that. Basically, the process is they send just a quick form, we fill it out, prove that we did the work, either film a video, show the pictures, show the receipts, and then they release the next draw, and then we get our next round of funding to go back and do the next part of our project. So it's a good way to do it. I know that you're going to be down here. We got a big REI Expo coming up. If you guys want to meet Brent, he's going to be down there. He's going to have a booth, right? So I highly recommend going down there. I know he was down there last year. Yeah,
we're going to be at booth 113, and I do apologize. I told you that we are going to be there. I'm actually going to be out of town, but I'm going to have two of my employees down there at the booth, and one of them's been with me for 7 years. She knows pretty much everything I know at this point, and she's really, really good. Her name's Tara. You can stop by and talk to Tara, but I'm always available by phone or email, of course. But yeah, I'm going to be actually out of town, so I won't personally be there, but they can always come up to my office locally. I have an office in Frisco. I know you're in Plano, so we're really close by and local. But anyways, sorry, go ahead.
Yeah, guys, his office is right down there by Stonebriar Mall, right? It's right up there.
Yep.
Right up Preston Road. Guys, CRlending.com. If you have a property that you want to get looked at by them to see what they're going to kind of loan, go down there, put in your information, and go ahead and see what they can do for you. If you're a wholesaler, it's a good idea to get to know the hard money lenders in your area for a number of reasons, but specifically, you're eventually going to get to where you're flipping houses on your own, but they have buyers. They work relationships with you in a number of ways. But guys, go down and meet Brent, or I guess he's not going to be down there, but go meet Tara down there at the expo, get their cards, kind of learn a little bit more if you're still trying to figure out this whole process. And Brent, I appreciate you coming on. We'll go ahead and put all your information down below, but go ahead and give out your phone number, email if you want to, or whatever you want to give out as far as contact.
And I know it's hard. I actually tried to get that website domain, but it was already taken. It's actually CRlend.com.
Okay. Sorry about that.
That's okay. Not CRlend. It's so common. People do it all the time, but somebody unfortunately already has that. But CRlend.com is our website. You can go there, check out our information, and read some more about us. And then my direct cell phone number is 214-912-5539. I'll just repeat it. I know people are listening. It's hard to write down everything. So 214-912-5539. Also, the email address, which will go to myself and my assistant, Tara, is info@crpink.com. Again, that's info@C as in Charlie, R as in ring, pink.com. And pink is like the color. So that's basically how you get a hold of us.
Yeah, guys, we'll go ahead and put it under the show notes and put it on. You can find this video on Investor Army Podcast YouTube channel. We'll go ahead and put all that down there. for Brent, so you can reach out to him there. I know he's on social media as well. Guys, Brent does loans for me, so if he doesn't for me, it's good for me. It should be good for you too, right? So go ahead and check him out. And Brent, I appreciate you coming on today, and looking forward to seeing you soon.
Thanks, guys.